How to Manage Cash Flow in a Growing Company. Brought to you by CFO On Demand from Fitzpatrick, Bongiovanni, and Kelly CPAs. Please support our sponsors. This month's sponsor is Persky, Marone, Brog, Barrera, and Bailenson. I'll be the speaker. My name is Lou Bongiovanni, and I am the managing partner and CFO On Demand. If you have any questions or want to offer any comments, I encourage you to please email me at my email address, which you'll see at the end of the presentation. Our webinar topic this month will include the following. Why is cash flow more important than profit? Best ways to measure cash flow, and 7 ways to manage cash flow in a growing company, which is different from managing cash flow in a company that is just starting out or a company that is fully mature. Let's get started. Just as a refresher, categories of cash flow get broken up into 3 different areas when you're dealing with businesses of any size. There's the operating aspects, the investing aspects, and the financing aspects. The operating aspects of cash flow is the cash in and out from the normal running of your business operations. Investing cash flow is the investment and the outflow of plant, property, and equipment, or investments in non-operating assets. This would also include any purchases of buildings. Financing is the cash in and out to borrow or repay debt and to have distributions to the owners. So financing is where you would finance the actual either in assets in the company or from cash flow from operations of the company. Why is cash flow so important? It tells you what the balance sheet and the income statement do not. If you look at cash flow, the statement similar to the balance sheet and the income statement, the balance sheet, you would equate it to the skeletal frame of a body. The income statement is the muscle. Well, the cash flow is actually just the bloodstream or the blood flow of the business as it relates to how the business operates and its value in the life of the business. What things do cash flow statements give you? Well, cash flow exposes operating inefficiencies. If you're having any problems, for example, with collections being slow or problems getting payments on your invoices that you receive, cash flow will make you aware of that. They'll quantifiably show you what's going wrong from the operations aspects of your business and where there are inefficiencies. It also provides investing limits. So if you're wondering if you can afford a large capital expenditure, the statement of cash flow will make you aware of that and give you some really good insights that the income statement and the balance sheet cannot. It also helps you determine the proper amount of manageable financing. So if you determine that you can buy this piece of equipment or piece of real estate or other business, this shows you how much you need to put down versus how much that you're able to finance. That's why this statement's so critical. When banks look to lend, they rely heavily on the cash flow statement because it gives them comfort as to how much they feel comfortable to borrow and how much collateral they will need. Now, the difference between profit and cash flow, many times small business owners use these terms interchangeably, and they are not interchangeable. One builds off the other. Profit, as most people know, is the revenue of the company less its operating expenses gets you to a net profit or, unfortunately, a net loss. The cash flow statement really starts with that net profit or loss and then adds or subtracts different aspects of it to actually indicate what the cash flow of the company is. It takes into considerations changes in accounts payable and accounts receivable balances from one period to another. It also takes into consideration how much you pay towards the principal part of your debt. It looks at investing, what you pay for in investing in any equipment or assets of the company. It factors in distributions, and it backs out things such as depreciation, which isn't something that you write a check for, and is relevant in profit and loss statement, but is not in cash flow. So cash flow, because it adds and subtracts these different variables, tells a different story, or an added story to net profit. I've been referring to different statements, and again, as a refresher, the three main statements, no matter if you're Apple Computers or Joe's Pizza Shop, are the balance sheet, the income statement, and the cash flow. They are the three main statements that tell a business owner how well or how poorly the business is going. And each of those statements have an importance to them. The balance sheet tells you where you're at in a specific point in time. The income statement tells you the profitability from year to year of a company, and cash flow, as I mentioned, tells you how well you're managing the cash in order to run your business or grow your business. And that's the part that I really want to focus on in the next few slides is if you're in a position where you're growing your business. And since many of our clients in the CFO on Demand program focus on growing their business, I see a lot of this happening as far as cash flow questions. So I thought this would be a very good topic to discuss. So what influences cash flow, the fluctuation of it and the changes in it? Well, three things that come to mind that are pretty common in what influences cash flow. One is the seasonality of a business. So many times, let's say you have a seasonal business, whether it's a boardwalk business or a business that relies on a specific time of the year, you need to manage the cash flow during that period of time, which will have certain demands, as opposed to the non-busy time or outside the season where cash flow needs to be managed differently. Many times business owners know instinctively how much they need before they enter a season in order to manage it, but they also know at the end of the season how much cash they need in order to carry them during the slow periods of time. Many things could be done as far as easing financing obligations during the non-busy time of the year to help cash flow, but that's something that comes with experience in managing the seasonality of a business. The next is the normal business cycles. So that is different from the seasonality. Seasonality tends to happen year in and year out, and that's a normal part of the business. Fluctuations in your business cycle are a result of there being up years and down years. No matter what type of business you are, if there's a cycle that normally occurs in a business, it usually runs anywhere from a 5 to a 7-year window when there's up years and there's down years, and you need to manage through those fluctuations. Usually the most difficult part in managing those fluctuations is managing the cash flow, because if it's a down year, you're hopeful that things will improve, so you might be inclined to not cut costs as fast as you need to, or during upswings, there might be opportunities that you want to take advantage of that may or may not be prudent as far as your available cash flow. So normal business cycles also create challenges when it comes to cash flow. And finally, the owner's personal cash flow needs become a factor. We deal mostly with small businesses that are owned by a small number of individuals. Some are family members, and it's very difficult to separate what the owner's needs are for cash flow and what the business can produce. Many times we've seen where there's a disconnect. The owner needs a certain amount of cash flow, but the business, let's say, it can't provide it on a normal basis, or it can't provide it when there's a downturn, and that creates some conflicts and some challenges that need to be managed in cash flow. So it's important to consider these three factors and how they influence cash flow. How do you measure cash flow? There's three primary ways in order to measure cash flow. One is to compare the cash flow through the statement of cash flow to prior years or prior periods, where you're comparing really cash flow to itself. You're looking at your company when maybe things have gone well and seeing what the cash flow there is there as your benchmark, and comparing it to where you're at now. That's typically what is done, and very easy to do once you have the information. Another way of measuring cash flow is to industry benchmark. So if you don't have much history, or your records are such where you can't go back as easily and compare your cash flow to times that were good times as a benchmark, you can compare it to the industry. You do have to be careful that you're looking at the right size company and obviously the right industry that you're comparing it to. But benchmarks are helpful as far as giving you a guideline for sure, and there's plenty of that information out there. We have a number of resources that we tap into. And lastly, probably the most common way of measuring cash flow is by using ratio. There's key financial ratios that give you an idea of where cash flow should be, given your size of your company. Also, you want to be mindful that these ratios are helpful, but you need to take into consideration what stage your company is, whether it's in the early stages, a mature stage, or a declining stage, as far as how these ratios come into play. But let's talk more about ratios. Three common ratios in measuring cash flow are the quick ratio. They also refer to as the acid test. And that's when you take your cash balance plus your accounts receivable balance, the sum of those two, and you divide it by your current liabilities. And this will give you your quick ratio, which industry-wide should be somewhere about 1 or slightly above 1. If that ratio is 1 or slightly above 1, your company is doing well with cash flow. And the higher that number is, the stronger your cash flow is. Another ratio, which takes more things into consideration, is your current ratio, which takes your current assets over your current liabilities. So current assets is not only cash and accounts receivable, it would be inventory and any other current assets that you might have, maybe notes receivable, and you divide that by your current liabilities. That number should be somewhere around 2 or slightly above 2. That shows that you have strong working capital. The current ratio is also called the working capital ratio. Very important ratio in order to indicate if you're able to pay your bills on a daily basis and if you have enough reserve on an ongoing basis to measure the available cash flow. And lastly, cash flow coverage ratio, and that takes your operating cash flow, which you get from the statement of cash flow, divided by your total annual debt. That's the principal and interest on your debt. And this tells a viewer, and usually the banks fixate on this, how well you're able not only to pay your bills, but to pay off loans relating to the operations of your business. And of course, that's important for banks because they don't only want to make sure that you have collateral, they want to make sure that you have the ability to repay the loan, and that is a very useful ratio. Now, next I'd like to talk about a ratio that's not often cited. These three are the most common ones when you look at bank covenants or you hear individuals analyzing a business. But the one that I think is most relevant for a growing company is the cash conversion cycle. And the cash conversion cycle takes into consideration the number of days to convert a product, frankly, or a service, costs paid to the revenue received. So when you start putting money into the production of a product or to obtaining a service to actually getting paid for the product or service you deliver. And the reason that's important is that gives the business owner an indication of how long it takes to convert the first dollar you invest into the process or the business to how long it takes to receive funds for actually providing the service. And the reason that's important for a growing company is as a company grows and your numbers get bigger, that timeline might be impacted. It might take longer. Your cash conversion cycle might take more days, and this is measured in days. It might take more days, which could influence how much cash you need to normally run the operations of your business. So it's important to know what that number is because, number one, the volume is growing because you're, let's say, expanding your company, but also the amount of days might go. And if the dollar amounts grow and the number of days grow, then the need to operate your company, the cash flow grows dramatically. So the factors that come into play is the days in production. So this is assuming that you're producing something. So the days to produce something, the days it sits in inventory before you sell it, then the days that you wait once you've made the sale that you're waiting to receive the funds from the customer. And you subtract from those three numbers the days it takes you to pay your normal bills. So let's say days in production might be 10, inventory might be 5, that's 15 days. Let's say the days in AR might be 30 days, so that's 45 days in total. And let's say it takes you 15 days to pay your bills because you want to take advantage of discounts. Well, that's 45 less the 15, that'll be 30 days. So that's your cash conversion cycle. It takes you 30 days from the time you actually invest in the process to the time that you get paid. So then you want to know in a 30-day window how much business you're doing, and that gives you a feel for how much available cash flow you need. It's a little bit involved to talk about it without actually working through it, but once you work through it, it's a very, very informative ratio, cash conversion cycle. Okay, let's talk now about the 7 ways to manage cash flow in a growing company. First, you want to make sure that bigger is more profitable. Before you go and think about growing your company and you're doing it because you're top line driven, you're an owner that has always been accustomed to driving sales and letting operations either take care of themselves or have someone else focus on operations. You want to stop before you get too far with that process and make sure that if you're going to grow this top line, how much is going to actually drop to the bottom line as far as profitability. So ways you do that, you want to develop a financial model, and many times the banks require this of you because they want to make sure that bigger is better for you. So one way that you do it is you put together a pro forma, so to speak, so that they have an idea and you have an idea of what's expected. So when you either have problems with the loan or the loan has to be renewed, you have some kind of benchmark that you're comparing it to. You want to also make sure that you obtain the benefits of economies of scale. So if you're growing the company, it's continuing to grow, where can you have some efficiencies, whether that's in the labor field as far as having existing employees take on more responsibility with minimal added cost? Is that buying equipment that will create efficiencies? They're all different examples of taking advantage of economies of scale as your companies grow. You want to make sure that you're fully in tune with where they are because they're not always readily apparent. And last is you want to consider operational challenges, and this is how the process or the people get influenced as you're growing the company. That needs to be taken into consideration because although these are operational issues, invariably they affect cash flow. And since one aspect of cash flow is operational cash flow and probably the most volatile, you want to make sure that the process and people influence on the growing company is documented well enough. Next is forecast the cost of expansion. You may have heard the analogy where if a rocket takes off, it uses a third of its rocket fuel just in the takeoff of it because it takes a lot of energy just to get things up and moving. And then once they're maintained, it doesn't take nearly as much energy. So the cost of expansion is important because that initial upfront cost, especially, is really vital because that's usually the time in the growth or the expansion that that there's a fair amount of money being spent, and sometimes hard to get your arms around it. So you want to use your past history to make assumptions. So if this is a multiple phase operation and now you're growing into your second or third or fourth phase here, you can look back on previous phases and say, okay, when we bought this building or when we entered this new market, it took us X number of time in order to obtain a certain amount of market share. So we want to be realistic with our assumption. If we move to one location and it took 6 months, it's going to be hard to assume that it's going to be a shorter window of time in this new location unless there's certain different assumptions. bullet point 2 is you want to remember to allow for ramp up time. Just kind of alluding to that a minute ago that if you have some past history, that's great. But invariably, and I don't care what size company you are, it could be the IBMs and the Exxons of the world. It doesn't matter. It's much easier for companies to predict their revenue targets and their cost targets. The hard part for any company is how long it takes to get to those targets. Sometimes if you guess wrong in a startup company where funds might not have been reserved for a 6-month ramp up, let's say you only had 3 months in reserve, well, you're going to have tough times for those other 3 months if you didn't leave enough of reserve. And in many times, small businesses fail, and usually that year 2, because year 1 they kind of limp through it, but by year 2, if they don't correct the problem early in year 2, usually there's not enough cash flow in reserve because there was a lot of engine fuel spent in the actual launching of the company or launching the expansion. And usually many companies run out of funds by year 2. So that's how you avoid it, whether you're a new company or whether you're in year 2 of an expansion. You also want to consider the hidden costs, the costs of elevating the size of the company, whether it's management training or travel or advertising. I don't have it listed there, but advertising is another one as well, as far as those kind of costs, which many people don't fixate on because they're there. Maybe they're a lesser amount now because the company is more mature. But as you go to that next stage of growth, those kind of costs will impact cash flow, and they're hard costs to finance. You can't really go to the bank and say, "Hey, you want extra cost for traveling or advertising." That doesn't sell as well. So that's money really you need to come out of your own operating cash flow, and that might be difficult because you might need it for other expenditures. Oop, I went too far here. Let's go back a slide here. All right. Item number 3. You want to ensure your credit is strong. Again, we're focused on you borrowing some of the funds there, assuming that it can't come all out of the operations of the business, which I think is an accurate assumption. So you're either going to borrow it from a lending institution like a bank, credit union, or private investors, whatever the case may be. You want to make sure that your global credit analysis is strong. Now, global credit score or analysis is not only your personal, but it's the personal coupled with your business. So you want to make sure that that's in a range that will support you wanting to borrow at a heightened level. What that number is can vary, so I don't want to throw out a certain credit score, but you want to make sure that that is strong and has a strong history. That will help once you get down to the nitty-gritty of actually borrowing. That usually doesn't come up right up front. It usually comes up in the middle of the process. Business bills and loan payment history is strong. This kind of ties in with the first one. You want to make sure that you're paying your bills on a timely basis as well as your loans. You want to establish to anyone, including yourself, that listen, we were able to do it at this level. Now we're ready to go at the next phase. If you're having troubles at a smaller phase to pay your bills on a timely basis and pay off your loans, there's an excellent chance you're going to have problems as you get bigger, no matter if you're entering to this great market that has been holding you down or whatever the case may be. You need to get your house in order once it's at the current level before you consider seriously stepping to the next level. Next is the personal credit score for all owners is accurate. You want to make sure that what's known to the outside world if a potential lender is entertaining financing any of this, you want to make sure that your credit score is accurate, and sometimes it's not because there might be items that were paid off that didn't quite get recorded, or items that show that the payment was not timely. You want to make sure that those things are all cleaned up. Okay, next. Determine best lending sources and structure. I don't want to get too deep into lending, but the truth of the matter is cash flow is influenced considerably in a growing company with how much that you're able to borrow. The more that you're able to borrow, or the closer to borrowing what you need, will put less strain on cash flow and will help the success of a growing company. So you want to determine the max you need to borrow, and that goes back to bringing together financial models, as I mentioned in step one, to see how much you absolutely need. Um, then you want to see what options you have with the banks, whether it's line of credit or asset-based lending, which lends based on, let's say, receivables, and see what the banks are able to fund as far as the max that you need. You also can look at government lenders such as the SBA is a very popular one, or the EDA, depending on the nature of uh, the investment and how many jobs are created. So there's a number of government institutions out there that could maybe supplement a conventional bank loan. And then private lending, to the extent that the first two don't satisfy, usually the next stage is going to either family or friends. Crowdfunding is one that's become more popular here as you're trying to gather more money. You might see some of those kind of fund me type things. And you're going to see more and more of that as that micro lending environment is going to start proliferating with small business owners. The other option is sell equity. So if you're fans of Shark Tank or The Profit, where they actually sell part of their business in order to raise capital and help with cash flow, that's very popular, and you see a lot of that in the TV shows where there's some equity being sold in exchange for helping relieve cash flow. And many of these businesses that are stuck aren't necessarily stuck with a bad product or stuck because a competitor nailed them. They're stuck because they're stuck on not having enough cash flow to get that next level. That's why cash flow is critical for growing companies. 5, you want to share your growth plan story. So you want to share the story with lenders or investors if you're talking equity, strategic partners that be businesses that you need in order to deliver your product or service, with vendors that might be servicing your account, and of course with customers. All of these 4 categories can impact cash flow favorably or unfavorably. So it's important that they all understand your growth plan story, and maybe you can get some assistance from them in order to help ease um, some cash flow or credit terms if need be. But if they all know the story and where they stand in it, you're much more inclined to get some favorable terms from cash flow from these groups. And these groups are critical to your growth. They are, they're also buying into the concept with you. Number 6, have a backup plan or 2. You can do all the planning in the world. There's going to be still internal weaknesses or opportunities that you want to take advantage of. There are going to be external challenges that you're going to have to face that you really can't control. So it's important to know, number one, what your break even is. So what's the minimum you need to be making, either by week, by month, obviously by year, in order to sustain the business at the level that you now are looking at. You want to predict timelines, as I mentioned in the other slide. That's the hardest to predict. You want to look at timelines, and because they're so hard to predict, you want to keep a close eye on those, because they should be factored into your backup plan. So a backup plan would look something like this, where it's, hey, we expect to break even in month 4 of this new operation. And then in months 5 and beyond, it should start growing at X percent or X dollar amount and then grow there. But let's say that 3 or 4 month period was not the right one. Maybe it's 7 or 8 because of factors you could control. It could be the weather, it could be competition, it could be the industry, it could be internally as far as a manager or a salesperson. A lot of things could influence it. So it's important to know, if that happens, what reserve do you have, or what's the backup plan? You could tap into some of those people who I mentioned on the previous slide to help there. And you also want the ability, if you can, to have a scale back plan, where if you maybe took too big of a bite in this next phase of growth, do you have the ability to pull back and pull back and maybe scale down and then take another swing at the growth step. Maybe you took a giant step and you should have taken maybe more of a baby step towards it. You have the ability to scale it back and then regroup there, as opposed to an all or none where you're taking this massive leap of faith. It's just more risky. You want to mitigate risk here, no question about it. Number 7 is follow a monthly cash flow budget. So once you've done the initial plan, you've gotten the financing in place, you're up and running, you have all these plates spinning with operations and marketing and such, it's important that you keep track on a monthly basis how things are going according to your initial plan. You don't do the initial plan or homework in order to get the financing and then stick it in a drawer and then hope for the best. It needs to be a dynamic uh, tool and a document that you can reference every month. So you want to determine the initial cash investment need, and then and if there's any shortfalls, just make sure you identify any challenges there, and you want to address that proactively. You want to break down the 3 cash flow sections. So you might be struggling with the operations, but you're doing better in the investing section than you thought. So maybe one could offset the other for a period of time, and if so, for how long? And again, like I said, this needs to be a living and breathing document, just as important, frankly, I think more important than your income statement and your balance sheet. Your statement of cash flow is going to tell you how things are going, and it's going to give you immediate feedback, which I think is critical, especially in a growing company where you don't have much time or room for error. Speed is really important with growing companies as far as the pace in which you grow. This will indicate almost like a speedometer, how, if you're going the right speed that you need to in order to keep up with that growth. It's really critical. So now, as a recap of the 7 ways to manage cash flow in a growing company, number 1 is you want to make sure bigger is more profitable, that as you grow, the amount that's going to drop to the bottom line is as profitable as you anticipated. 2, you want to forecast the cost of expansion, especially the initial upfront cost, and make sure that you have a good idea of what it's going to take initially to get there. And frankly, that'll lead you into the next phase of your expansion. You want to ensure your credit is strong, because if you're considering borrowing, which most likely you are, they're going to want to look at your credit history, and how well you were able to manage a small debt will tell them, will give them a pretty good indication how well you manage a bigger one. You want to determine the best lending sources there, whether it's conventional banks, which will be the cheapest, then government lending like the SBA will be more expensive. Private lending will be even more expensive. And then equity is the most expensive because you're giving away ownership of your company. So there are different combinations of lending sources, and you want to see what works best for you. And much of that is doing some analysis and exploring your options. Next, you want to share your growth plan with invested parties. They're not necessarily investing in cash, but parties that are going to be influenced, whether they're customers, um, whether they're vendors or owners, or investors of your company. You want to hear where you're at with the plan and keep them updated on it. Bad news especially should travel quickly. Have a backup plan or 2. Again, you have initial plans, you're looking out in the future, 12 to 24 months. In this day and age, that is a long time, and not too many people are looking that far out or are able to successfully look that far out because of the pace of change. You want to make sure you have backup plans in place as best you can. And lastly, you want to follow a monthly cash flow budget so that you keep track of these things. So if things come off course as far as your cash flow, you're able to make adjustments quickly. You don't want to just bury your head in the sand and just focus on operations and not keep your eye on the scoreboard. It's like playing a game and playing real hard but not knowing what the score is. No one would do that as a competitor. CFO on Demand is a program that we take great pride in, and we offer it to companies, especially growing companies, who find there's a challenge with managing the financial analysis and the myriad of financial decisions that need to be made made as you're growing your company. What we offer is that bridge between your internal financial reporting and the owner's desire for financial information on a timely and accurate basis in order to make the right business decisions. We see owners that are more reactive and struggling with growth to be more so business operators than entrepreneurs. We see the companies that take into consideration the financial information and make smart business decisions are more like business strategists. And from our experience, the business strategist beats the business operator every time, no matter what the size is. You could have a bigger business operator and a smaller strategist. That strategist will gain a tremendous amount of market share and will overtake the operator in a matter of time. We've seen that on larger scales with companies, and it also works very prevalently on smaller companies as well. So we encourage you to consider CFO on Demand if you're not already a client. If your company wants to grow, we have a tremendous amount of experience with that and can guide you along that path. Some of our upcoming webinars you can see here. The next one's on March 7th. It's called Improved Profits by Outsourcing Services. That's an area that we're getting a lot of discussion on. People are understanding the value of outsourcing services, but it's not for everything and it's not for everyone. And we'll talk more about that at the webinar. Next, we'll hear from our sponsor, which is Persky Marone.
Hi, this is Rick Marone, co-managing partner of Persky Marone, Brog, Barrera, and Bailenson, your local law firm which offers a wide range of services to a diverse group of clients. Our clients range from local individuals and business persons to Fortune 500 corporations. We focus on providing clients with exceptional legal work and individualized attention. Our specialties and experience enable us to offer clients the sophistication of a large firm and the personal service, cost, effectiveness, and innovation of a small firm. The entire staff knows that communication is key to the firm's effectiveness. We realize that every client is important to the firm. Clients must always be kept up to date. Personal communications must be prompt and courteous, and fees must be fair and reasonable. Our goal is simple. We strive to meet all of our clients' needs and concerns regardless of the complexity or difficulty of the matter. As a result, we have the dedication, fortitude, and commitment to see your matter through to the best result attainable.